Hey traders! Navigating the market can be tough, right? Sometimes, you just wish you had a clearer map. Enter the Advanced Liquidations Heatmap, get a clearer view of market trends. Understand shifts before they catch you off guard. Feel more confident in your trading decisions. No gimmicks, just a solid tool to help you trade better. Check out the Advanced Liquidations Heatmap at huntergatherers.tech. Please see the links in the description below. Have a nice day!
Casual Spring Sale. Reduceri de până la 30% în magazine și online pe tezio.ro.
Împreună schimbăm perspectiva.
think the issue really is, and this is an issue that that the European economic policymakers are very, very focused on right now, is over the longer run, Europe's productivity growth has been about half of the U.S. And so ultimately all you've got is hours worked, and that's largely a function of population, hours worked, and then output per hour. That's going to be your economic activity and growth. And so productivity is really the thing that can enable living standards to rise over time. And there are a lot of theories on why that might be. I think from an American perspective, I would tend to point to the more flexible labor market, and also a more fully built out set of capital markets, which is parts of which are very focused on funding early stage innovative companies. So it's not just a bank-centric system. We've got a very highly evolved financial system. That may be another factor.
Yeah. So plenty of other reasons there that are worth mentioning, I think. Turning back to you, President Knut, you gave a pretty clear signal, I think, that we're going to see a move in June. But a lot of the questions that people have put to us today have, stressed this point of, usually there's been this sense that the ECB has been following the Fed, and it's raised a bit of a question mark as to what degree can the policies of, the two major global central banks, with apologies to the Bank of England, how much divergence can we really see? So to what extent do you feel constrained by what the US central bank does, and would you perhaps be reluctant to cut in July should the Fed want to stand pat and leave rates as they are for the foreseeable future?
Look, I think if you talk about monetary policy of big central banks like the Fed and the ECB, that monetary policy always takes place in a global context. I mean, our markets are interwoven to a large extent, etc. At the same time, we both have clear domestic mandates that look on an economy which may be 10-15% open, but it means at least 85% closed economy. So much of our inflation is actually being triggered still by domestic factors. So what we simply need to do is construct our own inflation outlook for the euro area. And yes, Fed policy is, of course, one factor that has an impact. And if you think about international spillovers, the first things that comes to mind is through the exchange rate. If the Fed were to run a tighter ship than we were going forward, then probably that would lead to some dollar strength and euro depreciation, which of course leads to additional imported inflation. But at the same time, you will also have a spillover effect through global financial conditions. Bond yields internationally are also moving in tandem. If you look at the last few weeks and months, bond yields in the euro area have gone up significantly without there being a true euro area reason for doing that. It was just the spillover from the US. And that effect is, of course, disinflationary. So if you look at the two effects, it's not so clear which of the two will dominate. And it's therefore also not so clear whether the developments in the US will really have a meaningful impact on the inflation outlook in the euro area. I don't think it will change the direction of travel in the euro area that much.
So you'd be willing to cut in July too?
Well, we've been saying all along that we follow a data-dependent and a meeting-by-meeting approach. And I keep repeating here, it is essential what is happening in the labor market in particular, because services inflation is still the main remaining driver of inflation in the euro area. So we will simply have to follow the data as it comes in, both on underlying inflation trends, the labor market, etc. And that's why there is no commitment beyond June. We will just follow a meeting-by-meeting and a data-driven approach. And data, when it comes to the labor market, it's really about the comprehensive assessment of the labor market. It's too simple to just look at sort of contractual wages. Contractual wages are coming down. But one of the problems now is that we have negative productivity growth in the euro area. We had negative productivity growth in Q4. In Q1, again, it seems as if growth in employment exceeds growth in GDP, which means that probably next week we will get another negative productivity growth number. And that means that unit labor costs are actually still going up. And then the question whether profit margins are capable of continuing to absorb these unit labor costs, that's something that we really have to assess over time when we decide on future steps. So nothing, no commitment whatsoever, open mind for anything beyond June.
And just to turn back to the issue of US inflation for a moment, even though there's this sense that we did see a remarkable drop of inflation last year because it was, just so aggressive the year before that there is this sense that, there's still a public perception that prices are very high. How difficult is it to really feel as though you can keep credibility at times when trust in public institutions is under siege? And that's from Jeroen Broekman, who's from Leaders in Finance.
So I think for central banks, credibility is kind of everything, and we only earn that one way, and that's by achieving our mandate for the benefit of the public over time. And also, I would add, a part of that is sticking to our knitting. Don't take on politically fraught issues that are really not our mandate. Do your job and explain as best you can what's happening in the economy. Of course, the economy the post-pandemic economy has surprised everyone. I wouldn't single out any single central bank or group of forecasters. It's just been many things that were not supposed to be able to happen have happened. Nonetheless, we've made real progress on inflation. We're far lower than we were. I would say the risk that at the beginning we were very concerned that the very high inflation we saw might be quite difficult to bring down without a kind of very significant decline in employment and weakening economic activity. That didn't happen. That's just a great result. I think people are unhappy. You mentioned people are unhappy. That I fully appreciate that. And a big part of that, I think, is go to the store. Prices are high. You tell people inflation is coming down, and they think, I don't understand that. The price of all the things that I buy hasn't come down. So, they're not wrong. I mean, they're suffering. Particularly people at the lower end of the income spectrum are very hard hit by inflation from the start, which is why we're so strongly committed to restoring price stability and keeping it in place as long as possible.
And just to turn back to Europe now and to the Netherlands in particular, we're sitting in a venue here that's really testament to the power of trade, for good and ill. In an era of deglobalization, when we're seeing daily headlines about tariffs, and how does the Netherlands as a small open economy, and indeed the Eurozone as a very trade-dependent region, really thrive?
Yeah, that's a difficult question. I mean, it goes beyond saying that this is a development that is absolutely not a positive development for the euro area, and that we watch with a lot of concern. Now, fragmentation is there. The train has left the station. So, we have to think about sort of the ways that it can manifest itself and what we can do to try to best redress its consequences. There is a sense that international business is actually to some extent more resilient to political fragmentation than we have been thinking beforehand. So that international trade is a little bit like a river that sort of tends to find its way, even if some obstacles are being raised here and there. But of course, the fragmentation, it impedes the diffusion of technology across borders, so that means lower productivity growth everywhere. I would also not underestimate the limitations that it puts on our capacity jointly and internationally to solve global problems. In a fragmented world, suppose we had a global financial crisis again, like in 2008, 2009. It would be much, much more difficult to get the G20 around the table and to agree on a concerted remedial plan as we did in 2008, 2009, think about climate change, etc. What can we do about it? Well, I think in Europe there is still a lot of untapped potential to at least strengthen our internal cohesion. We're not tapping the full potential of the single market. In many, many places, the single market only exists in a name. We don't have capital markets union. I think we are really doing ourselves a disfavor. We don't have a banking union yet. And so we are missing out on opportunities to strengthen international trade, or sorry, inter-European, I should say, trade and integration, economic as well as financial.
Would you have anything to add on this topic? I know it's something that's featured in the Fed minutes about the links perhaps between trade barriers and inflation and so on. Do you see it as a risk?
So this is a very, very hot political issue, not just in the United States, but everywhere in the world. And not trade policy, of course, not the job of the Fed. So, I mean, we, as I mentioned a few moments ago, I think we need to resist the temptation to just have opinions on all different kinds of economic policies, as fun as that might be. You know, the elected government has to deal with these things, and they have to deal with the public on them. And they've given us really important assignments, and I think we need to honor the decision not to give us that.
And I appreciate this is also an awkward topic, but it is deficits in the sense that the national debt is forecast to rise by the Congressional Budget Office quite substantially over the next 10 years. Does that make your life trickier as Fed chair rather too?
I don't think it's not that it makes my life more difficult or the Fed's work more difficult, but I think it's you know, utterly non-controversial to say that U.S. fiscal policy is on an unsustainable path. Not that our fiscal position itself is unsustainable, but the path is unsustainable, meaning that we have full employment and we're running big structural deficits, and we're going to have to deal with this sooner or later, and sooner is a lot more attractive than later. I do hear from elected people on both sides of Capitol Hill and in both political parties that they do understand this. Mm-hmm. And I think you mentioned the Congressional Budget Office. I think everyone should be reading the things that they're publishing about the U.S. budget deficit and the path, and should be very concerned that this is something that elected people need to get their arms around sooner rather than later.
And you've noticed a lot, you've noted a lot that these supply side benefits that you thought might come, in 2021 or 2022 did actually arrive in 2023. Now, what sort of benefits from the supply side do you think we could see in 2024 and beyond?
So I think we probably have realized most of the reversal of the pandemic supply side effects, but not all of it. But I think we could get more sort of the final parts of the supply chains really getting sorted out. As I mentioned, the surveys of businesses, they still say there are shortages. They still say that they have a hard time hiring people, for that matter. So I do think we're still getting very substantial numbers of people coming to the country and going to work. Let me add, immigration also not a policy that the Fed works on or has opinions on, but I'm just giving you the straight economics of it. People come in, they can get a work permit, they are getting work permits, and they go to work and they're paying taxes and they're creating economic output, and there are millions of them. So
it's alleviating the labor shortage that we had in the industries that really had it the worst. So I think all of that, it probably helped at the margin a little bit in cooling the labor market off. It's both supply and demand, but we think at the beginning, in the longer run, it should be neutral on inflation, but in the short run, it might have been positive. So
I think that's a factor too.
And just to kind of tend to these broader demographic trends, there's been a lot of talk in recent years about how they will impact inflation, whether they have some sort of impact on R star, the kind of, the Goldilocks level of interest rates in the longer term, one might say. I mean, how do you think about these kind of longer term demographic trends and other factors, and how they're going to influence where you see this kind of magical Goldilocks neutral rate of interest?
So the R star, for those of you who aren't central bankers who read every word of every story Claire writes about us, R star is really a longer run concept. R star is a neutral interest rate that would neither push up on economic activity nor bring it down at some hypothetical future time when we're at full employment, we're at 2% inflation, and there are no shocks hitting the economy. So think 5-6 years down the road, there's this sort of nirvana out there. Its relevance for current policy making is kind of limited, and I think you need to say that. But really what we're doing in an FOMC meeting is we're looking at the broad effect of the things that we're doing on the economy, and we're asking ourselves, is policy tight enough? Is it too tight? We're looking at what's happening in the economy. We're thinking about lags. And it's not a debate over the level of R-star, because that's a longer run concept. Now, and the argument is made that R-star will go up, and this is a debate that economists have been having for some years now. But the idea is, between deglobalization and the need to fund the energy transition, and perhaps the need to spend more on military, and the aging of the population, bigger deficits, higher, all of that could push up what is a neutral rate. And I think those are interesting debates to have. But ultimately, we're not sitting around wondering what the longer run neutral rate is when we do policy. When we make policy, we're thinking today, is our policy delivering what the economy needs to move it toward the mandates that Congress has given us: stable prices, maximum employment.
So would you divorce it from, I think why this has come into focus, if you like, is because, now that, cuts are being considered in some parts of the world, at least there's this sense in which people are thinking, how low will rates go? Would you see that as part of the kind of R-star debate, or would you want to divorce the two factors of this current cycle and where R-star will end up being?
I think the R-star debate runs in the background, but again, it's a longer run concept. You could, if you wanted to think about a shorter run R-star, that would be more relevant. But that's not the way we think about it. We think about the effect of the things we're doing on financial conditions more broadly and on the economy. And how is it affecting the economy, and why? And all of those things lead us to believe at this time that policy is restrictive, and that it looks like it will take longer for us to become confident that inflation is coming down to 2% over time.
And how is this debate occurring around the table in Frankfurt at the ECB about longer run interest rates, or even, where are we going to end up? What's the rock bottom for this cycle?
Yeah, I mean, that's, of course, a difficult question to answer, because there are so many moving parts here. But what I would say is that if you look at the likelihood or the likely nature of the shocks that will hit us in the future, we came out of a period in which we had globalization, which was a slowly moving positive supply shock, ever more goods for ever lower prices coming from the rest of the world, which meant that for almost 10 years we continuously had to approach our inflation target from below. We had a low inflation problem. Going forward, with fragmentation, with aging of our societies, in my view, it's more likely that the shocks hitting our economy will actually be of the nature of negative supply shocks, not positive supply shocks. And if you think that through, that means that probably we will have to approach our inflation target more often from above than from below. And that probably suggests that we are not, at least I don't regard it very likely, that we will move back to the time in which we had a continuous sort of our fairly persistent low inflation equilibrium with very, very low interest rates. We probably have to, on average, run a slightly tighter ship because of the nature of these shocks that are currently relevant to our economy.
And just to come back to something that I think has been kind of in the background here for quite a lot of the discussion about high interest rates taking
possibly a while longer till they have the desired impact on some pockets of the economy. How do you see that? Is this a legacy of this very low interest rate era? And how do you really address that when it comes to monetary policy? That is there just going to be this lag from now on that didn't exist, say, relative to pre-2008?
So I think if you look at the bigger picture, we've seen the labor market's a good place to see this. You've seen demand for workers cooling off pretty substantially. The ratio of vacancies to unemployed people, for example, has gone from more than 2 to 1 to now 1.3 to 1, and it was 1.2 before. So that's a decline in demand. That's demand related. You also see wages coming down. You see quits coming down. So I think that tells you that policy is probably restrictive. I think it's also fair to say, though, that the U.S. economy is different this time for a couple reasons. One is that people financed themselves into very low rate mortgages, and now they won't move because they would be moving into a higher rate mortgage if they did, and they would be throwing a lot of value away. The same is true of businesses, many of which, as indeed you would expect, have termed out their debt. And so they're not feeling the effects of interest rates. So it may be that policy is hitting the economy not quite as strongly as it would have if those two things were not the case. Notwithstanding that, I think the overall picture still is policy's working, it's weighing on spending, it's weighing on interest-sensitive spending, and it's certainly weighing on the labor market. It's a question of restrictive policy. As I mentioned, our policy is the highest it's been in quite some time. The rate is, at 5.25% to 5.5% is high relative to recent history. So we think that it's probably a matter of just staying at that stance for longer, and that's how we're thinking about it.
And I mean, you note about housing and about the standard model in the US being I think I'm right, the 30-year mortgage is kind of the standard mortgage product. I think here in the Netherlands, flexible rates are quite more fixed rates.
Yes, absolutely.
So fixed rates are quite common too, but I imagine with shorter
10, 15,
duration.
An average mortgage, I think, has an average maturity of like 16 years. Of course, that's a little bit endogenous because of the low interest rate period we had for so long that, of course, mortgage holders tended to extend the maturity. So now, lately, it's been coming in a little bit. But still, we have a lot of fixed rate borrowing in the Netherlands, and that has, of course, also mitigated the impact of the monetary tightening, which has been stronger in those areas where there is more variable rate borrowing. But in general, I would say 85% of all financial intermediation in the euro area runs through the banks. So when you look at monetary transmission in the euro area, you have to look at credit. And credit growth has more or less come to a halt. As a consequence, we increased policy rates by 4.5% within 14 months. Credit growth came to a halt. That was a feature of the policy, not a bug. And credit has been flat for quite a while. And now we're also beginning to see the first signs of life again. Now that there is an anticipation that our next interest rate move will be a reduction of rates, you also see the first signs of recovery in credit. So in that sense, I think this is more or less how you would expect monetary transmission to take place in the euro area.
And how much of an issue has that been for you in the US, where we do have this, where capital markets play a far greater role, and where, for reasons that were never quite clear to myself, the turn of the year, the markets were predicting, 6 interest rate cuts by the Fed, and pricing credit off the back of that, and there being quite a big, quite substantial growth in lending and refinancing over the first couple of months of the year. How much more difficult does that really make your task that the banks aren't as big a vehicle?
For what it's worth, it's a minority of intervention, but banks are still important, and particularly for small and medium-sized businesses that don't have capital market access. And credit has been tighter for some time now, particularly in the wake of the turmoil we saw earlier last year. But still, credit growth has been modest, and that's another sign of tight financial policy. So that's part of the picture. I think the fact that we have capital markets are so important for many consumer loans of various kinds wind up in the capital markets or securitized and are not held by banks. It's just it's a very healthy credit machine for people, but they're feeling these higher. Those are short-term interest rates. I think that the ones that are longer-term interest rates are the ones where they're not feeling it, and that's really mortgages, and that's companies that have turned out their debt. I think other forms of consumer debt are short-term, and the surveys show that people think it's not a good time to buy durable goods like cars and washing machines, and the reason is it's a floating rate loan at a very high level.
Yeah, absolutely. And when you look at the banking system as a whole, we've seen some jitters, I think, on both sides of the Atlantic, but on the whole, it seems both systems are relatively stable, despite quite substantial rises in interest rates. Has that surprised you at all? Maybe first to Chair Powell and then to President Knott.
Has it surprised? Not really. Our banks are particularly our large banks are strong, well capitalized, very successful competitively, globally. They're in I think one of the reasons why the recovery broadly around the world from the pandemic has been strong as opposed to the one from the global financial crisis is that the very large financial institutions came through just fine. The U.S. banking system overall is in good shape. Banks are making loans, as I mentioned. Credit conditions are a bit tight, but that's part of our policy. So I wouldn't say I'm surprised. I think we obviously had a period of turmoil early last year, and we acted pretty quickly to stem the turmoil and also to go to work as a supervisor and make sure that banks had good plans on liquidity, had capital, understood the portfolio losses that they have for longer run securities, and are in a position to understand and manage those.
Well, I think it's pretty clear that if you have such an unprecedented rise in interest rates in such a short period of time, that this constitutes a massive shock to the financial system. So when we were sort of in the process of tightening, of course, this was sort of enhanced monitoring, an area for enhanced monitoring. Now, I think we can say, so far, so good. I entirely agree with Chair Powell that the core of the financial system has held up quite well. And I think this is in part, I think the success of the financial reform agenda that was rolled out after the global financial crisis under the aegis of the Financial Stability Board, which was very much focused about stronger capital, stronger liquidity, stronger risk management at the banks, which were at the core of the financial system, and that has clearly paid off. Now, there have been some idiosyncratic accidents here, the second-tier US banking system, Credit Suisse, but I think there were idiosyncratic factors behind it. The banks that had arrived into trouble in the US were not even part of the Basel III arrangement and the financial reform agenda. But I would say so far so good. The question marks today are much more in the non-bank financial intermediation space, where we have seen a couple of quasi-near-miss accidents, I would say. The Dash for Cash, the LDI, the Archegos, the commodity traders in February 22. So these have all been pockets of vulnerabilities where you saw a combination of excessive liquidity mismatches combined with pockets of hidden leverage that we were unaware of before. And that is now also front and center of the work program of the Financial Stability Board, much more the NBFI space. Of course, we have to learn the lessons from the few banking failures that we did see, and that is continuous maintenance. But I think if you were to ask me, my main focus is more on the NBFI space than on the banking space.
We'll come back to Credit Suisse because I know that's a topic that you've spoken about quite a bit, and a few of our audience have got questions on that. But non-banks, would you share that, that sense in which they're the big lurking danger in the financial system right now?
I guess I would say it this way. In the U.S., non-bank participants by non-banks in lending activities, for example, has been growing very, very fast. And it's a fairly new thing, and in many cases, whole markets are being now taken over, or now majority for non-banks. And so our job is to monitor that very carefully, because I'll say a couple things. One, there hasn't been a downturn yet. You worry about very fast growth in anything. It just kind of raises financial stability questions, and you wonder, is it a bubble? What will happen, and will it deflate, and that kind of thing. And so you want to be watching it carefully. I will say, though, it's different. Some of the we've spent a lot of time looking at it. I would just point to a couple things. One is many of the lending structures are not subject to run in the way that banks have traditionally been. The funding tends to be from limited partners who have their investment locked up for many years, and they can't get it out. So as opposed to the danger with a bank can be that all the depositors want their money at the same time, and that's the traditional problem that we've been trying to solve with bank regulation for hundreds of years. But these are different. They don't have, and runs are responsible. Bank runs or things like that are really responsible for an awful lot of the problems that happen in one form or another. So the non-bank financial sector doesn't have that as much. Another thing is the ties between banks and the non-bank financial institutions are substantial and growing. So there's plenty of monitoring for us to do there. It's not obvious to me that at this point that it's a net loss to financial stability, but I would say our jobs are to monitor it very carefully and thoughtfully and understand the implications.
And just to return to the topic of Credit Suisse, we had a question submitted ahead of the event. In your keynote speech at the 7th Annual Conference on European Systemic Risk, you talked about events surrounding Credit Suisse. What can the Foreign Bankers Association, to which we're speaking today, and the Netherlands Bank learn about the collapse of the Swiss lender?
Well, I guess the main thing one can learn about the collapse of Credit Suisse is the huge importance of governance, governance within financial institutions, because it is pretty clear that the events that led to the failure of Credit Suisse were not sort of a classic lack of capital or, let's say, too much credit risk relative to the capital. It was management failures, there was outright fraud, there were misinvestments, there was misbehavior, even at the top of the institution. And if you have a series of governance failures at an institution, it will lead to an erosion of confidence. That erosion of confidence will lead to deposit runs, which, by the way, already took place much earlier than March 23. There was already a significant outflow of deposits also in the fall of 2022. And so we have to remind ourselves, it is not only about capital and liquidity. Governance of financial institutions is of utmost importance.
And are there any questions about AT1s and the treatments of those particular instruments that you think can be drawn in the Dutch context?
Yeah, of course, there was a case where AT1s have been completely written down. So I think it behooves us
to look a little bit deeper into this issue, why the AT1s were drawn down, whereas equity was not fully written off.
This was, by the way, completely in line with the contractual provisions of the AT1. It was just that not all investors had really read the contractual provisions, so they pretended they were surprised by it. But I think from every case, I think we should try to draw some lessons. But in this case, at least, it allowed the authorities to write down 16 billion Swiss francs, which was helpful to generate the interest of UBS to actually take over.
And now turning back to you, Chair Powell, we've got a very nice question here from Liu Zhan from ICBC, who asks, during COVID, the Federal Reserve applied high levels of monetary stimulus to further raise asset prices and support growth. Bloomberg called you Wall Street's head of state as a reflection of how strong your actions were on asset prices and how profitable your actions were for Wall Street. How does that make you feel, and how do you look back at this with the benefit of hindsight?
It makes no point of contact with the way I remember those days, so whatsoever. So I would just say this: if you put yourself in the place where we were in March of 2020, no one knew how long it would take to have vaccines. No one knew whether millions of people were going to die fairly quickly, or how long the economy would remain closed, or was it even going to be possible to reopen the economy if it had to be closed for a year? What was that going to look like? So I think it was so uncertain that I came to the view, and my colleagues did too, that we really needed to use our tools in ways that we hadn't before, because I would never have been, if things didn't work out, I didn't want to, if we had to go through a really deep, lengthy downturn, I would not want to have to explain why we didn't do that. So we did, and what happened is we announced these very aggressive, vigorous programs to support markets that we had never had to support before, the municipal market, corporate debt, these were red lines that we said we'd never cross. But the thing is, when we made the announcements, the markets healed themselves. So we made very, very few loans. We had something like 6 trillion in lending capacity. So the announcement effects of the things that we did, it really worked this time. So I think, broadly speaking, that the initial response was very successful and involved ultimately very, very little in the way of actual lending, a lot of announcements. Then the story goes on, and you have the reopening and the inflation, and we're still living through that. I think we'll have to judge that from a greater distance.
Anything you'd do differently in retrospect?
There's nothing I would do differently in the initial response. I think we did very well, and I think that the world continues to benefit from the strong response that we took, and we really avoided an awful lot of a bad tail risk there that could well have come due. Again, I would say on inflation, when inflation kind of unexpectedly arose in the first quarter of 2021, I think we're going to need to. I've tried to resist reaching conclusions about that episode until it looks so different now than it looked a year ago. For example, all the progress we made in 2023. I think we're talking about it in a completely different way now. I think 2-3 years from now we'll be doing the same. So I don't want to try to learn lessons, in the middle of the story.
Sure. I think that's very fair. And another question here that's just been submitted from Abir, who asks, is Chairman Powell confident about the degree of independence of the Federal Reserve in relation to the executive branch of government? Do you think you have the powers that you need to defend your independence?
Yes, without question, I do. I think when I talk to elected representatives in both political parties in the House and the Senate, and I think there's very strong support on both sides of the aisle, on both sides of Capitol Hill, for an independent Fed. I think people do understand that we're just there to do our job on a non-political, non-partisan basis. Nobody's perfect. Everyone makes mistakes, but the Fed is doing the absolute best we can with the tools that we have and the understanding of the economy that we have. I think that is very broadly understood and supported on Capitol Hill. So I'm less worried about that than the sort of things that have been in the press lately might suggest.
Okay. The same question to you. Do you feel as though the ECB's independence is well enough enshrined?
Oh yes, I think the ECB has one of the strongest statutory independencies of maybe all central banks in the world. And let's zoom out just for one moment. I mean, this inflation shock that we had, if you compare it to the previous inflation shock of the same magnitude, which was the 1970s, when we didn't have independent central banks, the main difference why I think now we have a credible prospect of getting the problem under control within, let's say, 3 or 4 years, while in the 1970s it took 10, 12 years, and the disinflation was so much more painful. The sacrifice ratios were so much higher, high unemployment, etc. The big difference is central bank credibility. During this huge inflation wave, inflation expectations continued to be well anchored. They never drifted away from 2%. This is so different to the 1970s. And why were inflation expectations so much better anchored this time around? Of course, that you can have a debate about it. It's about psychology, etc. But I would posit that the higher degree of central bank independence is clearly an integral part of that story. So this is a very tangible way in which we can show to society the benefits of having independent monetary policy making.
And would there be anything that you'd like to add to that on the case for central bank independence?
I think Klaas said it very well. I mean, and I think in the United States we don't have quite the constitutional, support that you have for it. It's a statutory arrangement. It's an institutional arrangement that has benefited the public. And that's all it is. Congress can change it any time they want. It would take Congress to change it, though. There's nothing the executive can do. I don't think that's likely, but as long as what we're doing is keeping our heads down, working on the things we're supposed to be working on, doing our absolute best, and explaining ourselves as best we can, acknowledging mistakes, and going forward, and that we will have the faith in our independence that we need, and I think we do have that now, and I'm determined that we'll continue to have it.
And I think that's a very suitable note to end this discussion on. I'd like to take this opportunity to thank the Foreign Bankers Association for putting on this wonderful event, the organisers Richard and Maxine, at Cognito Media, our audience here, and many of you joining online, and of course our panellists. Both of you have been superb. Thank you for joining us, and enjoy the rest of your day. Thanks a lot.
Thank you. You're welcome. Thank you.
Good. No, please sit, because we Jake, sit for a minute, because we would like to thank you officially also from the whole board, from the Foreign Bankers Association, who has asked me and given me the honor to say some closing remarks after this really impressive session and hearing to the world leaders when it comes to monetary policy and central bank leaders in the Western Hemisphere. My name is Jens Pollen. I'm the other chairman of the FBA, and I'm the Chief and Risk and Financial Officer and Executive Board Member of Mature Bank Europe here in Amsterdam. Can I just say, wow, an insightful discussion about financial markets, the underlying conditions, and the differences about Europe and the US. Also about how to connect the dots. Thought that was a very interesting start of the session when we're also talking about the two different continents. Therefore, and in line with all the thanks that have been given here today, let me also take this opportunity to thank the guests of honor and other distinguished speakers and supporters and contributors here today. First and foremost, of course, a big thank you to J. Paul, taking the time in his very busy schedule and also during the US presidential election year to attend and speak here at the FBA special event. It's been really an honor and privilege of having you here and listening to your insightful comments. As my fellow co-chairman has already alluded to, this has been our dream and making for years. Your long-standing expertise and great insight to the topics of monetary policy, fiscal stability, and supervisory challenges are true testimony to your leadership as a chairman of the US Federal Reserves, and also during the very turbulent times we have seen over the last few years. We wish you all the best for the period ahead, and whatever the outcome of the US presidential election, we hope your leadership of a stable and prudent monetary policy will prevail. The FBA will also like to take this opportunity to thank Klaus Knott, of course, who has been really an amazing supporter of the FBA over the years, and also DNB's recognition about a diversified landscape, not only benefiting the Dutch banking landscape, but the economy as a whole. Let me not forget to also thank Arti for her insightful comments on the connecting the dots, and also Claire, who skillfully were able to moderate the dialogue between Jay and Klaus, and also asking very interesting and pointed questions. On behalf of the whole FBA, I would also like to say a big thank you to our driving force behind the FBA, and already for many years, Arlette Kudam. Without you and your immense support to support the FBA, its members, and the FBA board, and the wider community, we would never have been able, and certainly not being able, to hold these great events as we have here today. May I get an applause, please? Please allow me to also extend a thank you to everybody who has been supporting and organizing this event, including Team DNB, Cognito, and also all the staff present here today. Additionally, we would like to thank all our business partners who throughout the years dedicate their time and resources to provide an immense value to our
requirement. To me, the child tax credit is paying for the work of being a parent, which is work that benefits us all. To attach additional work requirements to that sort of undermines this intent of helping families in a way that makes sense for them.
There are two other policies that economists and other experts advocate for when it comes to helping families: subsidized childcare and paid family leave. These policies go hand in hand because paid family leave means parents can stay home and take care of their children themselves.
The U.S. is the only OECD country that does not have a federal paid leave program.
Less than a quarter of U.S. workers have access to paid family leave by their employer.
There is a law on the books at the federal level that requires employers to allow parents to take unpaid leave up to 12 weeks, as long as the private employer has 50 or more employees.
When it's unpaid, it's not really an option. It's not really a choice that many families can take across this country. And it's not just low-income families or many middle-income families that are living paycheck to paycheck that simply can't afford to take leave how it is now.
What we see is that Black families, Latino families, Native American families, workers are less likely to be able to afford unpaid leave from work than white workers. Again, reflecting and enhancing racial economic disparities across the board.
There are some states and localities that have passed paid family and medical leave, and that provides for paid parental leave as one component of that to make sure that workers actually have the option to take that leave.
Each state with paid family and medical leave sets its laws up differently, but typically the law requires employers to provide workers with up to 12 weeks of fully or partially paid leave per year. The programs are often funded by payroll taxes from workers, with some states also requiring employers to contribute.
Paternity leave for me was 16 weeks, and that's full 100% salary. We wouldn't be able to do what we're doing without any kind of leave.
One of the issues with childcare in the US is it's a patchwork system. We have programs that fully subsidize for eligible children a childcare seat, programs like Head Start and some state preschool. We have tax credits that subsidize a portion of childcare costs for higher income families. And then we also have block grants to states to help them expand access. And the problem with all of these systems is that with this multitude of approaches, we're not getting close to universality or affordability. We're not helping the workers in these sectors, and we're not doing enough on quality.
There's a lot of value in having states move forward and do these kind of programs. But ultimately, to have it be something that's available to everybody everywhere, you need the federal government to be willing to make these kind of investments in care infrastructures.
There's so many moments that I would have missed if it was, back in the day where, fathers would get like 2 weeks. And those are some things that I will cherish for the rest of my life.
President Biden tried to address all of these policies at the federal level with his Build Back Better infrastructure bill that he proposed even before he entered the White House.
The president doesn't talk a lot about the Build Back Better bill, but that was his proposal that included things like an expanded child tax credit, like a near universal childcare program that would have capped the amount of income people had to pay toward childcare. It included a paid leave type program, really included these big building blocks of a better family support program that ran into opposition from one key Democrat, Senator Joe Manchin in West Virginia.
One of the things that I think is important is that we think about rebalancing our investments toward children because it pays for itself. If we were to rebalance federal investments away from senior citizens and toward children, not only would raising a child be more affordable in the US, but the children would have sufficient resources. Their parents would be better able to think about how they want to spend their time, whether it's that extra hour at work or an extra hour playing with their kids. All of those things become possible if we rebalance federal spending toward kids.
We know that investing in our children has a multiplier effect. What it means for those children's families, what it means for those children in adulthood, and what it means for the entire economy just have incredible ripple effects. And so investing in children actually impacts Americans of all ages, in addition to our entire economy.
The boxes flying down the line at this 2.3 million square foot distribution center are sorted, scanned and labeled, then loaded into trucks destined for the shelves of the country's biggest retailer. Walmart employs more people than any other company in the world, and 90% of Americans live within 10 miles of a Walmart. Yet when it comes to e-commerce, Amazon is the clear leader, with 39.5% of the market share compared to Walmart's 7%. And with the global pandemic helping shift shoppers' behavior for good, dominance in online shopping is now paramount. Last year, people spent more on Amazon than at Walmart for the first time. Now Walmart's got a new playbook and new leadership as it races to catch up.
We have 4,700 locations across the US, and if the store acts like a fulfillment center, we can send those items the shortest distance in the fastest time.
Over the past few years, Walmart's built more than 30 warehouses like this, some with robots and people, entirely dedicated to fulfilling online orders. Workers at stores are also picking and packing online orders as Walmart turns dozens of stores into micro-fulfillment centers. It's added membership program Walmart Plus to compete with Prime, invested heavily in local delivery programs in homes and with drones, and started packing and shipping orders for third-party sellers as it works to entice them to Walmart.com.
I'd say assortment is the linchpin to this plan, and then sellers are a means to get to assortment.
They're looking at Amazon's market share saying, how can we grow this market share? We need more sellers. We need more selection.
Customers trust us for food consumables, they trust us for general merchandise, but they're looking for every item that they could think of. We want to make sure that we're able to do that for them.
CNBC went to Walmart headquarters in Bentonville, Arkansas for the first ever public interview with Walmart's new head of e-commerce, Tom Ward, to find out the truth behind his big plans for catching Amazon online. Walmart was founded in 1962 by Sam Walton, growing to nearly 2,000 stores by the time Jeff Bezos founded Amazon in 1994. Despite its in-store dominance, Walmart was notoriously slow to the e-commerce game, not launching its third-party marketplace until 2009. It didn't make real headway until 2016, when Walmart bought discount online retailer Jet.com for $3.3 billion, tapping founder Mark Lowry to lead e-commerce, where he stayed until last year. In 2018, it spent big to get into the booming online market in India with Flipkart, and also bought online fashion brands like Bonobos and Eloquii. Then in 2020, Walmart shut down Jet.com, although CEO Doug McMillon says he would buy it all over again.
You look at the trajectory of our business, it changed when we made that acquisition. The Walmart brand really has extended to reach all kinds of people, affluent customers, younger customers, urban customers. We were going to need a brand to be able to use to attract some of the brands that did not yet want to be in our stores.
Also in 2020, Walmart partnered with Shopify to bring thousands of mom-and-pop sellers to Walmart's marketplace. That's the term used to differentiate items sold by third-party sellers from the first-party merchandise bought and sold by Walmart. 2020 also saw the launch of Walmart Plus and Walmart Fulfillment Services to rival Fulfilled by Amazon, or FBA, but leveraging stores and their built-in workforce to keep costs low.
Walmart's definitely, doubling, tripling down on their e-commerce business, trying their best to take market share away from Amazon or catch up to them. The truth is, though, they still have a long ways to go.
Last year, Walmart opened up its marketplace to international sellers. This summer, Walmart Plus Weekend is happening for the first time, with exclusive online deals for members, just like Amazon's Prime Day. And in February, Tom Ward took over Walmart's e-commerce division.
The nearest Walmart to your customer is the one in their pocket. It's also the ultimate store. It should be an endless assortment. It should be completely, full of solutions for whatever customers are looking for. And increasingly, marketplace sellers really help us do that.
We went to a bustling conference for e-commerce sellers in Las Vegas in March that's usually dominated by Amazon chatter. For the first time in the Prosper Show's 7-year history, Walmart also had a major presence.
Because they're smart, and they know that this show is where the sellers are. And they want to get a lot of more brands on the Walmart.com channel.
It's the only other platform that it could really be competition to Amazon.
Michael Lebar started selling on Walmart 7 years ago when he was just a sophomore in high school.
At first, my mom was not happy because my whole room was just a bunch of USPS boxes.
Now, Lebar says Walmart.com is his primary platform for his Spawn